So looking at the accounting process. So it's very imperative that we understand the accounting cycle and the steps that are involved in posting transactions, and also to understand the duality concept in financial accounting. So whenever we are posting, we need to have our inputs, which are our source documents. So these source documents will be entered for processing using the accounting cycle to produce our final accounts or final statements, which we can have as the balance sheet, comprehensive statement, cash flows, and also statement of equities ownership. So here are the steps in the accounting cycle where we start with analyzing the documents, we put them into journals, you post the entries in the ledgers, then you prepare a trial balance, and you prepare what are called the financial statements. So the books of original entry are also called the books of prime entry. So we have what is called the general journal, which we use when you're recording books before sending them into the ledger accounts. And we have the general ledger, which we often use as a T account, in which case um, we post them. Then you need to follow the duality concept. The duality concept where every debit entry must have a corresponding credit entry. Then we undergo the postings. So I'll take you through the procedure, but firstly, a few terminologies we need to understand. We have what is called an account. An account is simply a record that either increases or decreases a specific asset or liability or equity or revenue or expenditure item, whereas a general ledger is simply a record that contains all accounts. It embodies all accounts. So we have different types of accounts. We have what we call the asset account, where all resources in the business are recorded, like the cash, debtors, motor vehicle account. All these are assets. An asset is simply what the business owns. Then we go to a liability account, which is simply amounts that a business will owe. So when a business is owing, we call those liability accounts. We also have what we call capital or equity accounts. These are simply accounts where the business owner will put in their own money. We also have expense accounts. Expense accounts are simply accounts like salaries, telephones, where you're going to do what? Where you're going to make your expenditures. So we have revenue accounts or sales accounts. These are accounts where you're going to get either your cash or your credit sales. So with that being said, I'll teach you a principle which is called PERS. PERS is simply our guide that we're going to use to understand accounts that we're going to debit, accounts that we're going to credit. So the acronym is PERS. If you're going to spell them, PERS looks like this. So this is a T account. Whatever you are debiting, you're receiving. Whatever you're crediting, you're giving out. So all purchases have a debit entry. All expenses have a debit entry. All assets have a debit entry. All revenues have a credit entry or capital. Liabilities have a credit entry and sales have a credit entry. Now, you must also understand the terminology that an asset is what we own. Assets can either be capital or we have non-current assets and current assets. So the current assets are simply what we own that can easily be converted into cash. What are some of the current assets that a business can own? Cash at hand, cash at bank, our payables, or our receivables, which we call debtors. If somebody owes you money and they're here to pay you, we call those what? Receivables. Altogether. So these are what we call our current assets. Then we also have what we call our liabilities. Our liabilities are payables. So what we're going to pay out. Altogether. So now we're going to
Yes.
put some transactions that we're going to post in these accounts. So you need to really understand how to post these accounts using the duality concept. So let's go quickly and look at our accounting equation. Our accounting equation must be given as follows. Assets must be equal to capital, or assets must be equal to capital. Assets must be equal to capital plus liabilities. This is the accounting equation that we're going to use when you're going to deal with the balance sheet. So now I will take you through a few transactions that we will need to post in what we call a ledger account. So this will be the basis upon which you're going to do what? Upon which you're going to enter all your accounts. So the T account looks like this. So this simply says to debit whatever you're receiving, you credit whatever you're giving out. Okay? You debit whatever you're receiving and you credit whatever you're giving out. So let's try to look at some of the accounts that we can consider the T account. So in the T account, whenever we're increasing assets, we debit them. Whenever we're increasing expenses, we debit them. Whenever we're increasing capital, we uh, we so this is how the duality concept looks like. So using pairs, this is the principle we're going to use. So at this point, we're going to take you through a few transactions that may need your attention. So number one, if you are given a transaction like started business with cash, okay? So let's look at some of the transactions that we can have. So we can say started business with cash at hand. Started business with cash. With cash at bank and cash at hand. Cash at hand, we say maybe 10,000. Cash at bank, 10,000. So which two accounts are we going to open? We're going to do the T accounts. Remember, for every debit entry, there should be a corresponding credit entry. So this is a special account that we're going to open, the capital and the bank account. So remember, all assets have a debit entry. All revenues have a what? Credit entry. So to increase assets, we have two assets here. We have bank and we have cash. So if we're increasing the bank account, because the bank is receiving cash of 15,000, so we debit it here, 15,000. So the name of the account that it's corresponding with is the detail that we're going to say here. So we're going to put this capital. 15,000, then here we're going to credit here, we're going to put this bank here, 15,000. Okay, the next account was cash for 10,000. So since cash is a it's an asset, we're going to put this what? Capital. How much? 10,000. Okay. Then here we're going to say cash 10,000. Right. So let's go to another transaction. Paid rent for cash 2,000. What accounts are we having here? Paid rent for cash 2,000. What two accounts are we having here? We have the rent account and the cash account. So because rent is an expense account, we're going to debit it. And cash is giving out, it's reducing. We're going to credit it. Okay? Are we together so far?
Yes.